The question we ask is, post-spin, are these assets that we would want to hold in the long term? Cameron, what do you make of the numbers, and did you get an answer to that question in any way today?
So we think that that is the really big point for GE going forward, mostly if you're a longer term investor, because post the spins, post the breakup of everything, you have to look at these individual businesses and ask yourself, do you want to own companies that are somewhat orphan, meaning that they're undiversified businesses, at the same time that some of them will have liability overhangs? And so in today's number, to get the surprise increase in the insurance liability certainly doesn't help spark a lot of optimism about the direction going forward. So in our view, we think that there's probably easier ways or higher quality ways to get exposure to similar end markets without having to own these orphan assets that do have liability overhangs.
Cameron, let's talk a little bit about kind of a subsector of industrials, if you will, which is, of course, aerospace and defense. One of the major talking points right now is that geopolitical risk from around the world, not just Russia, Ukraine, but also China, Taiwan, even Iran, and the UAE via Yemen. Let's talk a little bit about how the names like Lockheed Martin, Boeing play in someone's portfolio as perhaps a geopolitical hedge.
Sure. So we think defense is actually a really cheap way to hedge out geopolitical risk within portfolios. If you look at the valuation of defense names, they're trading at the same discount to the market that they were trading during the sequestration of 2012, when defense budgets were cut 10% across the board. So as we start seeing some of these geopolitical tensions start to heat up, we do think that this will increase demand for these defense assets, which really have been unloved for much of the past 20 months. Investors were concerned that you weren't going to get exposure to the cyclical upswing in markets at the same time that there was fear that there would be crowding out of defense budgets given fiscal spending in other areas. But if there's more risk on the geopolitical front, mostly from those near peer competitors, which are places like China and Russia, it really would support continued growth in defense budgets and thus an acceleration in the earnings and an improvement in the valuations.
Yeah, it's going to be interesting, a different world when it comes to maybe pricing power and the ability to deal with the inflationary impulses we're seeing in lots of parts of many of these businesses. Brooke, let's just talk about that inflationary impulse that we're seeing. Culp talked about it a little bit earlier on, talked about some of these cost pressures being persistent. What did he tell you on the call about this, and what is the long-term outlook for margins if we are going to see some of these issues being persistent?
Where they're seeing just supply chain pressures most significantly right now is in that healthcare business. So the CFO said on the call that, if it were not for shortages in everything from resins to semiconductors, they would have seen, about 7 to 8 points higher organic growth in that healthcare division. But some of these supply chain pressures are also starting to creep up on the aviation side of things, as well as labor challenges. We also heard this from Raytheon today, which reported its earnings as well. These are obviously businesses that cut pretty deeply during the pandemic. They just did not have the business to support the workforces that they did pre-COVID. So there's going to be a lot of rebuilding here. And, when I talked to Larry Culp this morning, he said they're certainly not immune from the widespread hiring challenges that we keep hearing about from all different corners of the economy. And so it's going to be really interesting to see how that plays out. We're already hearing from so many aerospace companies that they are quickly preparing for what will be a supply problem rather than a demand problem.
So, Brooke, not immune, but perhaps more prepared for how long this is going to last. Did he give any indication of what their kind of preparations are for, say, these pressures that, dare I say it, aren't seeming to be transitory?
Sure. So they said that they expect supply chain challenges to linger at least through the first half of 2022 in the healthcare unit. On the renewable energy business, that's where they expect inflation to be the most significant. And that, of course, echoes comments that we heard earlier this month from Siemens Gamesa, which said, they're seeing really meaningful increases in raw material pricing for their wind turbines. I think, to be perfectly honest, it's anyone's guess how long these pressures are going to last. And in the third quarter earnings season, we did get some brave CEOs, including Lennox CEO Todd Bluedorn, willing to say that, the peak has passed on supply chain challenges. But as we're still talking about this in January, I think CEOs are going to be much more conservative, much more cautious.
Cameron, what are you factoring in on margins? There are pressures across the board. Demand is strong, and we'll probably see long-haul demand come back in the aviation sector a bit more strongly this year. So the demand picture looks pretty good. Satisfying that's going to be difficult with the supply chain story. So how does this work? How does it work with margins? Is that where the pressure starts to get felt this year?
So I think we have to speak about broader industrials and aviation to the side, because aviation obviously saw a much deeper downturn and is just starting to see the recovery in demand in that long haul, as you said, which should help wide body demand eventually. We also are seeing really strong growth in the aftermarket business. If you look at the Raytheon numbers from this morning, the sequential growth in aftermarket in places like Collins and Pratt & Whitney was very, very strong. So clearly we're seeing an area where you can continue to see pricing power be strong, even though you're having issues with your costs, whether it's because you can't find welders on the labor side or your raw materials are moving up. But on the broader industrial side, we're actually starting to see signs that maybe there is a deceleration in that top line revenue. If we look at things like the ISM PMI or the market PMI, what those are telling us is that we're actually starting to see some of the pricing powers start to fade. New orders are rolling over. We're seeing things like South Korea exports roll over quite quickly. Things like Japanese machine tool orders roll over quickly. All of this points to lower revenue growth on the top line, which could mean that pricing power will be weaker in 2022, despite the fact that costs are likely going to remain elevated because of raw materials and because of labor. So if we think about the broader industrial cyclical area, we could see more margin pressure because of that issue with price and cost.